In today's video, I'm going to analyze the 7 giants of the US stock market from 5 different angles, in a detailed and nuanced way. I'll also share some short-term actionable data, such as the current valuation of each stock, so you can make more informed judgments and moves during the next earnings season. However, the core value of today's video is to look at these 7 companies from a long-term investment perspective. I'll tell you what makes them attractive right now, what the risks are, and what you should be paying attention to in the future. Time is short, and we have a lot to cover. So make sure to subscribe to my channel, turn on the notification bell, and like, comment, and share so you won't miss any new updates. All right, let's officially begin. Microsoft, among the 7 giants, the company most widely recognized in the investment community as having the deepest moat, is Microsoft. Microsoft has always been solid, not soft at all. Its performance, net profits, and free cash flow have grown steadily by around 10 to 20% per year. Think about it. This is a company that has maintained continuous growth for 40 straight years, ever since 1986, with a market cap nearing $4 trillion. Its profitability has stood firm through both bull and bear markets. For every long-term value investor, Microsoft is simply a must-have company. Today, more than 66% of Microsoft's revenue comes from B2B cloud services, products like Office 365 and Azure, the world's second-largest cloud platform. The highlight here is that investors can visibly see AI integration in Microsoft's financial results. Some people say AI is just hype. Big companies throwing money around while ordinary people can't feel its impact. I totally disagree. Whether it's AI or the early days of the internet, every breakthrough technology evolves from the top down. The first users are governments and the military, followed by large corporations, and only after that does it reach ordinary consumers. Government applications are usually opaque, but enterprise-level adoption, especially B2B, is extremely transparent. From Microsoft's own press releases, we can see that AI-related performance contributed 16% to its cloud growth rate. Globally, cloud revenue is growing at about 25% per year, but Microsoft's is growing at 33%. Clearly outperforming the market. That's the impact of AI, even if most people can't feel it yet. Of course, no company is perfect. Microsoft's biggest headache right now is the delay of its in-house Maya 200 AI chip. Production has been postponed multiple times. Their capital expenditures in 2024 and 2025 have increased several-fold, which signals that they see a once-in-a-generation opportunity, and that opportunity is AI. To seize it, Microsoft needs to control its own AI chip design. They've already signed agreements with Intel to produce chips designed by Microsoft itself. We'll come back to that point later. Now, let's look at Microsoft's valuation. Most Wall Street analysts see the fair value around $621, with an upside to $710 and a downside to $483. Its PEG ratio has long stayed above 2, currently about 2.26, meaning the stock price is high relative to its earnings growth. But this is true for almost all of the Big 7, except one special case we'll discuss later. Apple. I've done an in-depth analysis of Apple before, even made a precise valuation model for it. At that time, Apple's stock briefly dipped into my fair value range and quickly rebounded. If you want to learn more about Apple, check out that 22-minute video after this one. So, how's Apple doing now? Every time Apple holds an earnings report or product launch, the stock price hits a new record high. Yet its growth rate has significantly slowed, even declined in some quarters. Many users complain that Apple is just squeezing toothpaste, no innovation, uglier designs. But people, myself included, still keep buying. Why? Because Apple's greatest strength is its ecosystem lock-in. Even if we complain, we can't easily leave. My entire daily workflow, from devices to data sync, is tied to Apple. Switching away would just cause unnecessary trouble. That user stickiness is Apple's superpower. Its software and services segment keeps expanding, which shows this deepening bond between users and the company. Meanwhile, Apple's profit margins are extremely high, thanks to economies of scale and supply chain efficiency. But Apple investors also face three main risks. Weak growth. iPhone market share is stagnating or declining. Low AI integration. Apple hasn't fully tied its products to the AI trend yet. Antitrust pressure. The US and EU accuse Apple of being a closed ecosystem. Some analysts fear regulatory risk, but unless Apple is truly broken up, fines are just background noise. As I've said before with Google, any drop caused by a fine is a buying opportunity. One visible growth catalyst for Apple is its push to develop its own AI chips, integrating on-device AI inference, offline processing, into future products. If successful, older devices won't support the new AI features, forcing users to upgrade hardware. That could reignite Apple's growth. Wall Street currently considers Apple overvalued, fair price around $251, with an upside to $315 and a downside to $175. Its PEG ratio is about 2.47, again meaning price growth outpaces earnings growth. Google, Alphabet. As for Google, it's simply a profit machine. Its net profit margin and free cash flow are among the highest in the world. Where peers make $4 to $5 of profit per $100 revenue, Google makes 8 times that. Most of Google's income still comes from search advertising, which continues to hit record highs, even as critics question the company's dominance. AI has also had a measurable positive impact. Since rolling out AI overviews, Google search traffic has grown about 10% globally, proving that AI integration can boost results. But since ChatGPT's release, Google's biggest concern has been AI competition threatening search. Even internal executives admit that ChatGPT and Gemini are inevitably cannibalizing search traffic. So Google must make Gemini profitable fast to offset that risk. At the same time, Alphabet keeps investing in future technologies like Waymo, autonomous driving, Wing, drones, and quantum computing, all trillion-dollar future markets. Just one or two successful other bets could redefine Google's revenue ceiling. It's also developing its own AI chips for training and inference to power Gemini. Wall Street valuations put Google's fair price at $249, with a range between $185 to $300. Its PEG ratio is 1.68, better than Microsoft or Apple, indicating a relatively balanced valuation. Nvidia now to the star of the show, Nvidia. After the pandemic, Nvidia transformed from a relatively minor player into the leader of the Magnificent Seven, with a market cap over $4.4 trillion. In the past 3 years, its revenue, net profit, and free cash flow have all exploded by 100 to 200%, driven by demand for data center and high-end AI chips. Analysts still see about 20% upside, with a fair price around $218, upper target $320, and lower target $100. Its PEG ratio is only about 1, meaning its growth rate fully supports its valuation, actually the lowest among all 7 giants. Why? 2 reasons. Supply shortage. Global AI chip demand is growing at 21% annually through 2030, but Nvidia can't produce enough. Supply lags by 6 to 9 months. Predictable performance. Nvidia's financial guidance has been remarkably accurate. Every quarter, Jensen Huang raises the next quarter's forecast and never disappoints investors. That makes Nvidia the most financially predictable company among the seven giants, maybe even worldwide. Still, Nvidia faces three pain points: geopolitical risk. US-China trade restrictions on high-end chips are short-term noise but create volatility. Future oversupply. TSMC's capacity expansion around 2026 to 27 may alter supply-demand dynamics. Customer independence. Every big tech company, Microsoft, Google, Amazon, Meta, Tesla, is developing its own chips to reduce dependence on Nvidia. Why? Because AI workloads include training done behind the scenes and inference done in front-end applications. Nvidia dominates training chips, but for inference, its products are too expensive. So companies are designing cheaper custom inference chips to lower costs. Nvidia's challenge is to transition smoothly, keeping its training chip dominance while building an ecosystem for inference. That's why Nvidia is investing in robotics, autonomous driving, industrial automation, and healthcare, trying to make AI and physical computing platform-based, locking the future intelligent world into the CUDA ecosystem. That's Nvidia's biggest long-term opportunity.